the way I look at it is if you look at the timing's always difficult, but if you look at the three previous gold bull markets, the first one in the early 70s, from trough to peak, gold went up 5.6 times. The second one in the late 70s, it went up from trough to peak 8.2 times. And the early 2000s, from say 2000 to 2011, it went up 7.9 times from trough to peak. If you call the bottom of this market about $1,050 in 2015, then we should end up $8,000 at the end of this cycle.
The gold market is moving faster and more violently than most investors have seen in decades. Sharp, abrupt price surges and extreme volatility are signaling that something significant is unfolding in the precious metals sector. Brien Lundin noted that recent gold movements are particularly striking, with prices rising dramatically over the past few weeks, behavior not seen since January 1980, when gold reached its last nominal high of $850 in a very short period. According to Brien, these rapid moves alone set the current bull market apart from previous cycles. Brien emphasized that the dynamics behind this market are unique. Central banks are driving much of the demand for gold while largely ignoring silver and mining stocks, leaving these traditional avenues underperforming relative to gold. Using the 2015 bottom of around $1,150 as a reference, he estimated that gold could reach $6,000 to $8,000 by the end of this cycle. He also mentioned that if gold were to be reattached to the dollar or other currencies in some way, the ultimate peak could be even higher. Looking beyond price action, Brien highlighted structural issues in the gold market. He pointed out that when gold is returned ahead of schedule, it is immediately melted and recast, with no verification of its original identity, and multiple indicators suggest difficulties in moving gold to its intended locations. He further emphasized that if gold and silver were once again recognized and legalized as money with floating exchange rates, individuals could protect their wealth from currency devaluation. Even in the face of government manipulation of fiat currencies, holding gold and silver would allow investors to preserve purchasing. Before we dive deeper into the discussion on gold, silver, and the unfolding changes in the global monetary system, don't forget to like this video, subscribe to the channel, and hit the bell icon so you stay updated with every new insight.
Yeah, it's a little scary, frankly, in recent weeks, and we've had a few surges over this 18-month bull market similarly to this, but even over the last few weeks, we've had a tremendous surge, and it's been violent, and it's been abrupt, and it's volatile in one direction, primarily up, and so we haven't seen anything like this, I think, since maybe January of 1980, when gold hit its last nominal high back then of $850, when it went up, tremendously over just a few weeks. But that's happened a couple of times in this market, and by that virtue alone, it's distinguished, I think, from any previous bull market that we've seen. But there are other aspects that are different, like the fact that this one's been driven by central banks buying, largely with the absence of Western investors until recent months. And those Western investors are, if they want to get involved, and as they're trying to get involved in the sector, they see how far gold has come, and they look at how they're going to enter the sector. And interestingly, because central banks have driven it, because central banks don't buy silver and they don't buy mining stocks, the traditional levers for gold, they find that these sectors have lagged, and they're entering the play via silver and gold. And we're starting to see that reaction as well. I think gold's saying that something is ahead, and it's going to be disruptive, but we're not quite there yet. So yeah, I think from that standpoint, we've got a good bit more to go on in this gold bull market. It is tiny, and you're seeing the major Wall Street houses, Goldman Sachs and Bank of America and the like, coming out with constantly revised targets on gold, chasing the price up, and sometimes their revised targets get overtaken by the gold price before the ink is dry on their last projections. And frankly, a lot of their validations, a lot of their justifications rather, for higher gold prices are a bit convoluted, and I think don't strike to the heart of the story. So yeah, the issue right now is that, well, every bull market in gold is monetarily based. It's based on people uh, looking forward and feeling that there will be a more rapid depreciation of the purchasing power of their currencies. That's what drives gold over the long term, and that's what gold is telling us now, that that's going to happen. Now, as far as the relative sizes, if we just get a fraction, small fraction of the money that's out there in tech stocks and AI and crypto and Bitcoin and whatever the hot word or the theme or the theme of the day is on Wall Street, if we get just a few ladles full of that liquidity thrown into the mining sector, for example, even metals and mining, then the reaction would be explosive because the market is so tiny. It's just a small fraction of the giant oceans of liquidity that are sloshing around the world looking for a home. And that's starting to happen right now. We're starting to see people who are involved in those other sectors making a move into gold. We see Tether Gold buying, tons and tons of gold each month and putting $100 million into a royalty joint venture. So I think the camel's nose is firmly under the tent now, and it's just going to be more and more money coming into the sector. I would tend toward earlier in the game. I'm thinking third inning thereabouts. It's hard to say anything earlier considering how far gold has come, but and it does feel a bit frothy right now. Hardly anything goes up in a straight line. Although this bull market in gold has been as close as you can get, I think. Uh, the way I look at it is, if you look at the timing's always difficult, but if you look at the three previous gold bull markets, the first one in the early 70s, from trough to peak, gold went up 5.6 times. The second one in the late 70s, it went up from trough to peak 8.2 times. And the early 2000s, from say 2000 to 2011, it went up 7.9 times from trough to peak. If you call the bottom of this market about $1,050 in 2015, then we should end up $8,000 at the end of this cycle. Now that's the thing. We don't know when that cycle is going to end. I hope it takes a good, healthy amount of time to get there so we can make a lot of money in the mining stocks along the way. But I think that's the end game. I think that's where we're going, with an outside chance of something much higher if they try to reattach gold to the dollar and or other currencies in some way. And where's the gold? So everything we've seen has indicated that there's something squirrely going on with central bank gold reserves. Germany demands repatriation of half of its gold reserves that are in the U.S., and the U.S. says we can get it to you in 7 years. That seems to be a pretty obvious indication that the gold's not there. When we do return the gold ahead of that schedule, it is immediately melted and recast. Nobody looks at the serial numbers to see if it's the original gold.
Mm-hmm.
More and more indicators are out there showing that there's problems getting gold moved and getting gold where it should have been. And I think that, it's not just the official purchases, it's not just Poland, it's not just Estonia, it's not just China building their gold reserves through official purchases. But I think a lot of it is replenishment and putting gold where it should have been all along. The violence of the moves that we've seen just seem to indicate that. If gold and perhaps silver are legalized once again, recognized as money, you don't have to have a set exchange rate with the dollar. You can have a floating exchange rate. The key is that no matter what the powers that be do to the currency, no matter how they degrade the purchasing power of that currency and pull those levers, and you'll never be able to convince them not to be able to have that power, then people can still protect themselves without the friction of taxes and the like by owning gold and silver. And that's really all you need. Give them the power to do whatever they want with the currency that becomes increasingly worthless. But as long as you can protect yourself and hold wealth in a form that won't depreciate, you'll be okay.
Brien Lundin highlighted the growing importance of silver and other critical metals as both monetary and industrial assets. While he had previously focused on silver's monetary value, he pointed out that industrial demand is now projected to consume nearly all the silver mined globally on an annual basis within the next few years. This convergence of monetary and industrial demand creates a unique price dynamic, with potential for significant upward pressure on silver. Brien also stressed that the focus on metals is increasingly tied to security of supply, noting that the U.S. is adopting industrial policies like China's to ensure access to strategic resources, highlighting the geopolitical as well as economic significance of these metals. In addition, Brien observed that many exploration and mining companies remain historically undervalued, despite gold and silver's recent price gains. Deposits that would have sold for $150 per ounce in a typical bull market are currently trading at just $20 to $30 per ounce, and companies that once held uneconomic deposits are now fully viable with current gold prices, yet the market has not fully recognized their value. He emphasized that this creates a rare opportunity for investors, as these undervalued and now economic projects, combined with the rising demand for silver, could generate substantial gains as the market gradually catches up to the true potential of these assets. Let's get back to the interview.
I've always, for decades, discounted the industrial demand of silver because most of its value comes from its monetary value, its monetary cachet, and very little from an industrial standpoint. But the industrial usage right now is projected to take up every bit of silver mined in the world today annually on an annual basis within the next few years. So that alone, if you have monetary demand driving the price, and then all of a sudden you have industrial demand taking all the supply off, then that creates quite the situation from a price standpoint for silver. So it is going to be the solar panel manufacturers and every other industrial user of silver that's going to take that silver off the market over the next few years as a matter of an ordinary business. The fact of the matter is, at some point, these metals, not just silver, become strategic, and at any price, what an industry or even a country needs to do is worry about security of supply more than the price. And I think that's going to happen, not just to some degree, not just for silver, but for metals, a lot of metals across the board. Yeah, it's security of supply. We've seen that over history, that it's important in certain areas, and now it's becoming the U.S. is moving to mimic a lot of the industrial policy of China. We're trying to establish rare earths. The U.S. government has taken a stake in the largest rare earth miner in the U.S. Computer chips. We've seen them take stakes there, the golden shares and the like. So it is as much as we might be free marketers, and in my case, libertarian minded, there is a place for national security today and sourcing these metals. Not so much gold yet, but silver assuredly. If you look at it over history, and if you, as much as they move the big miners by a lot of standard metrics like price to net asset value, price to earnings, and et cetera, they're still at the low ends of their ranges, even after these big moves, because the moves in gold have been so extraordinary. And the miners have just started to respond to that. If you zero in a little bit and look at the GDX to gold ratio, you'll see that on August 1st, almost to the day, that they took off like they were shot out of a cannon. And that's impressive when you consider what gold has done since August 1st. So they have been outperforming gold itself by a tremendous measure, and you can see that on the chart. That's that last rocket shot up. They've got a long way to go, and again, gold's got a long way to go in my opinion. So the gains are going to be remarkable, and that's the big miners. Certainly, as you move down the food chain into the intermediates and then into the junior exploration development companies that we focus on in Gold Newsletter, your risk goes up, but so do your potential rewards. And in a market where a rising tide is lifting all boats, your risk is being mitigated because even your losers aren't losing. Your underperformers are still, at least staying put or gaining a little bit maybe. And you don't have the big drops that you may have in a bear market in that sector. So yeah, it's a very exciting area. We've seen some tremendous moves in the Gold Newsletter portfolio of recommended stocks, but we're coming up with other ones that this inefficient market has overlooked, and that we think have, are going to be the big winners of the next year. And now those companies are selling for $20 or $30 per ounce in the ground. Those kinds of deposits in a normal bull market, not in a buoyant bull market like we kind of are in on the metals standpoint, have typically sold for $150 an ounce. So
oh, wow. Okay. So yeah, so quite low still historically.
Still quite low. And in a rollicking bull market where M&A and companies are outbidding each other and the big majors are spending like drunken sailors, then they might go for $400 or $500 an ounce, especially when the price of gold is $3,700, $3,800, even soon perhaps $4,000 an ounce. So that's the kind of environment that can, and I think frankly will develop over the months and years to come. So there are still tremendous values, even though they've moved so much. From the exploration standpoint, there were companies that were trading for $5 million market caps, $10 million market caps, and now are trading for $20 to $30 million market caps without resources, with really good targets and some excitement behind them and money to drill. Those are the kinds of plays that if they find something could be worth many times those values on both the market cap and share price level. So the game's changed a bit, but it's not yet to the historic levels that would be thought of as being really frothy. I think there's a couple of if you look at it thematically, I look at companies on an individual basis, but if you look at it thematically, the companies I just mentioned that have big resources have not been appropriately re-rated. There were for many years companies that had really big resources that were out of the money, uneconomic at then gold prices, and they were supposedly leveraged bets on a rise in gold, where all of a sudden they would become economic, and then all this value would flow to the bottom line. All of those companies, every optionality play is now economic, and economic as of $1,000 ago in the gold price, and they have not yet been re-rated by the market. So I think that's one thematic area that I like. The other area I like is silver mining stocks, silver juniors, because silver naturally leverages gold, and silver stocks, equities, silver mining and exploration and development stocks leverage silver. So you can stack leverage on top of leverage by getting some of the top companies in that space. So those are two areas I like. And frankly, I'm always a sucker for a good exploration play. So I throw some of those in no matter what's happening if I see one, because there's nothing like the excitement of having a company that you have a decent position in all of a sudden make a big hit.
Gold and silver are entering a pivotal phase, driven by rising investor demand, central bank accumulation, and growing industrial use, especially silver, which may soon absorb nearly all mine supply. Many mining and exploration companies remain undervalued, with previously uneconomic deposits now viable but not yet recognized by the market. This convergence of monetary, industrial, and strategic factors creates significant upside potential, offering investors opportunities for strong long-term gains and wealth preservation. How could the combination of rising industrial demand, central bank accumulation, and undervalued mining companies impact the future prices of gold and silver? Stay tuned. If you're interested in real, data-backed insights on the financial system, hit like and subscribe so you never miss weekly updates. Thank you for your support, and we hope you enjoy the video.